Thanks for your company for the weekly this Friday, the 20th of November. I'm Jessica Amir, market analyst with Bell Direct. Well, Aussie equities have been bullish, to say the least, up for the third straight week, rising to a new 9-month high. From Monday to Thursday, the market gained 2.2%, gaining 10% over the past 3 weeks. Now, we know markets are forward-looking. Investors have been pricing in what the future may look like, given we've got 2 potential vaccines around the corner from Pfizer and Moderna, with another 2 in the pipeline from Johnson & Johnson and AstraZeneca. So traders have been continuing to buy stocks that look cheap compared to February levels and that are leveraged to the global recovery. Banking stocks, the standout and bought the most this week, seeing the sector lift 6%. Energy followed up 5%. Consumer discretionary stocks also doing well, along with real estate, mining and industrial stocks, while the stay-at-home economy stocks lagged. The tech sector fell the most, about 2%, followed by utility providers and telcos. We've been speaking about this rotation to economic recovery stocks for a while now, and notably this week, Morgan Stanley recommended their clients embrace cyclical stocks, saying to buy Qantas, REA Group, ALS and Scentre Group, and sell Metcash, APA, Tabcorp and Crown Resorts. In mining, they say to reduce gold stocks and increase copper exposures, like buying Oz Minerals, given the copper price is at a 29-month high. But what have been the biggest weekly stock moves? Well, French shopping mall giant Unibail-Rodamco-Westfield rose the most for the second week, up 30%. Bank stocks also continued their rally. Bendigo gaining the most in the sector and building momentum, up 15%. Its biggest weekly gain since June. Now, Bendigo's stock is in an uptrend too, as its 50-day moving average price looks like it's about to cross the longer-term 200-day average, indicating potential further growth. But if you look at the banking sector from a fundamental perspective more broadly, we learnt this week Australians are bouncing back on their feet. The Australian Banking Association says the majority of deferred loans are now being repaid. Now, deferred loans are down from $250 billion in June to 86 billion. And from a technical perspective, the chart tells us the financial index, made up of the biggest banks, is likely to see future growth, with a 50-day moving average just crossing above the 200-day moving average. Why is this so important? Well, the banking index, the biggest part of the Australian share market. So you'd expect, given all the tailwinds behind us, we've got stimulus, record low interest rates, a Santa rally, potentially a Santa rally that is. Vaccines are expected next year. Uncertainty is fading post the US election. Now, all of this is why the Aussie share market is likely to continue to grow over the next 12 months. And looking at where we are now, the ASX 200 is up 44% from the COVID low, about 9% away from the record hit back in February. Now, US equities continue to hit brand new record highs this week. And even though the ASX 200 is not there yet, some really pivotal things took place this week that are worth considering. Firstly, unemployment data came out not as bad as expected for October. Unemployment was expected to worsen from 6.9 to 7.2%, but it only weakened to 7%. Why? Well, about 180,000 people gained jobs in the month, with growth in Queensland, New South Wales and WA. All in all, though, this simply means Australia has recovered about 75% of the jobs lost since the pandemic, which is encouraging, particularly as Victoria still has 7.4% unemployment alone. But Citi says things are likely to get a little bit worse before they get better. National unemployment expected to peak in the first quarter of next year at 7.4% and then improve after the second quarter onto 2020 onwards. So with more people in jobs next year, you'd expect retailers, banks, insurers, consumer discretionary stocks to all do well. The second consideration is that another promising vaccine was announced. So now Pfizer and Moderna are racing their vaccines to be approved for emergency use, and they're hoped to be made available as early as next year. We've seen small company share prices benefit from this news. So the small cap index is up 9.5% this month. Travel and tourism stocks also doing really well. Qantas up 21%, Flight Centre up 42% in November. Now, beyond this, I encourage you to think about what stocks will likely do well for the next 5 to 6 months before a vaccine arrives, and ask yourself which companies are likely to see earnings growth. Now, the third consideration is that the corporate watchdog, ASIC, handed down a highly awaited report into the buy now, pay later sector. No new regulation was recommended for now, but regulatory changes are coming into effect from October next year, all to protect the consumer. We don't know what that will look like yet, though. But what's really interesting is ASIC warned that about 15% of consumers who had taken out a loan to pay their buy now, pay later service, and 1 in 5 people had been missing payments, with missed payment fee revenue totaling $43 million. Afterpay, Zip, OpenPay, and the Hum owner, Flexi Group, were all mentioned in the report. Also consider that Afterpay collects 73% of the sector's transactions and says that its bad debts are reducing. Bell Potter and Morgan Stanley say the ASIC review was pretty much a non-event, and we're more encouraged that Afterpay is on track for a record month in November, and that by this time next year, Afterpay will be in Europe and launching in Asia. Now, Bell Potter increased its price target to $140 for Afterpay. Morgan Stanley is now targeting $120. So there's plenty to consider. From all of us here at Bell Direct, have a happy and safe weekend. Bye for now.